Fund Supermart, your online gateway to unit trusts.
We continue to favour Asia ex-Japan equities with an emphasis on North Asian markets. Does Kenanga investors share the same view?
Yeah, we continue to like Asia. The emphasis on North Asia was actually a view that we held last year. But this year, I actually see relatively better value proposition in ASEAN. Okay, the ASEAN market actually suffered a greater loss in value last year, with the equities in some of these countries actually falling by as much as more than 20% in US dollar term. I think the fall was actually due to a confluence of factors, including general slowdown in economic growth, the currency weakness, as well as capital outflow. I think some of these negatives have been priced in after the sell down last year. So we do see a greater chance of rebound for ASEAN equity this year. Okay, for North Asia markets, of course we remain invested over there, especially in the Hong Kong, China markets, because I think the recent and potentially further correction in those markets actually provide buying opportunity into some of the H shares that we like, as valuations become even more attractive. I actually believe the Chinese government has the policy tool actually to maintain or to transition the economy to a more sustainable but slower path. But the Chinese renminbi is likely to continue to depreciate, and that will probably lead to more capital outflow.
Are there any countries or sectors that you are bullish on, and why?
I think for North Asia, we like the new economy sectors, the e-commerce sector, the pharmaceutical, the healthcare sectors, and we also like the renminbi depreciation story, especially the exporters who are leveraged on the improving consumer demand in the developed markets. For ASEAN, we actually like the reform-focused Indonesia, while Malaysia, I think, offers a defensive investment destination and at the same time offering some alpha opportunities. Sector-wise, we continue to like companies that stand to benefit from a strong US dollar and falling commodity prices. I think dollar strength will likely continue this year, as long as the normalization of interest rate process continues in US. But the rate of appreciation of US as against other currency may likely moderate because after the sharp appreciation last year. Yeah.
Speaking of Malaysia, what is your outlook for Malaysia this year?
Unfortunately, I think we have to brace ourselves for another volatile market this year. Okay, on one hand, the external headwinds like falling slower China growth and the rising interest rate in US are not exactly behind us. On the other hand, I think domestic sentiment is likely to be capped by continued weakness in the ringgit, subdued corporate earnings growth, as well as falling commodity prices. Okay, valuations wise, we are not exactly cheap compared to regional peers. But on the bright side, we have seen some stability on the political front thanks to the resolution of around the 1MDB debt issues. Also, I think Malaysia being one of the worst performer last year in terms of US dollar term, with the KRCI falling by as much as 22% in US dollar. I think we may be poised for a rebound this year. Okay, the undervalued ringgit may bring foreign investors back, not forgetting that we have domestic liquidity remain in abundance, supported by a large institutional base, and the potential injection, 20 billion injection by value cap, could provide a backstop to the market. So I think the market could stand a good chance to rebound actually in the second half. What are the catalysts for rebound? Possibly in terms of improvement in corporate earnings, and hopefully also stability in the ringgit as well as commodity prices. Okay.
Oil prices have dipped to new low. What will be the implication of this on Malaysian government fiscal budget, the corporate earnings, and on the ringgit?
I think based on the current budget or the previous budget, so to speak, the fall in oil price and the oil-related revenue was about 10 billion. Okay, that 10 billion was supposed to be offset by subsidy rationalization, especially the GSC implementation. But admittedly, oil prices have actually fallen further to about $30 per barrel level now, as compared to the $48 that assumption that the government used in the previous budget. So it is hard to imagine that the target 3.1% fiscal deficit that the government has can be maintained without any cut in expenditure or corresponding increase in revenue. In terms of corporate earnings, I think the direct impact of lower oil prices are actually on earnings of the plantation and the oil and gas company in terms of lower sales, in terms of lower margins, potential loss of contract, or worse still, some impairment losses. Okay. But on the other hand, I think there are some companies that stand to benefit from lower oil prices, especially those companies whose raw material are actually derived from petroleum or oil derivative products. Okay, so but these companies typically don't feature in the KLCI component stocks. So you don't actually see headline corporate earnings being improved on that ground. In terms of ringgit, yes, I think the continued fall in oil prices are going to weigh in the sentiment on the ringgit. But I think a lot has been priced since after the sharp depreciation last year. Actually, at this point, I think the direction of ringgit is more affected by regional currency, especially the renminbi, rather than oil price now. Yeah.
Are there more values to be found in the Malaysia small to medium cap space as compared to large cap?
We certainly see value in a small and a mid cap space because a lot of these companies fly under the investors' radar and they are yet to be institutionalized, right? But the challenge for us is to actually gain corporate access into this company because a lot of them are actually family owned and they typically have very little exposure to institutional investors, and large broking houses of asset managers don't typically dedicate too much of the resources to these companies. So for this year, I think the opportunity still lies with the smaller companies with strong earnings growth in the right sector. Okay, and we typically still like the exporters team because, like I mentioned, US dollar strength is likely to continue, although the rate of appreciation is going to slow down a lot more than last year. But within the exporter teams, we like the glove manufacturers. Okay, we like the technology companies, especially those who produce consumer electronic components. We like the OEM outsourcing companies, especially those the testing, assembly, or plastic molding, space. These are the exporter teams that we like here.
Are there any other opportunities that you would like to add on for Malaysia?
Malaysia, apart from the exporter team, we still see value in the infrastructure, utility space. I think this year the development expenditure and the infrastructure prime will still continue. So typically these companies in these sectors will benefit.